Hey investor friends, I'm Michelle Markey, and today I'll be going through the top 8 beginner investing mistakes that I've mostly observed from others' behavior, as well as included some of my own. And believe me, I'm not perfect. I've made plenty of mistakes and I'll continue making mistakes, but I try to reduce them as much as I can. And if you're interested, feel free to check out my top 10 investing mistakes video so you can avoid some of the mistakes I've made when it comes to investing and a little bit of trading, but mostly investing decisions I've made in the past. And vicariously learning from others' mistakes is probably the second best way to learn, with the best way being to go through the mistakes yourself. But you'll save a lot more money not having to go through the mistakes in the first place. And I'd love if you could please smash that like button for the YouTube algorithm, and please subscribe, because I'm here to help you be the best investor you can be. Thanks. I would say the number one mistake is not knowing yourself, and this includes not knowing your goals or your tendencies. And ask yourself, what is your temperament or your usual set of behaviors based on your values? Are you the type who likes to save money or impulse buy and then struggle to know where the money went? And are you trying to invest for the long term, like for retirement, or are you just trying to make a quick buck in the markets? And are you the type who likes to go along with the flow and seek safety in the herd, or do you like arriving at your own conclusions? These are all very important questions to ask yourself to get to know who you are before you invest your very first dollar in any kind of asset. Does fear of missing out or FOMO cause you to take action after you see your friends or people on Reddit seemingly getting rich off the latest and greatest thing? Or do you find yourself buying the hottest IPO or SPAC just because of some hype? Or do you beat to the tune of your own drum? And it's important to ask yourself, how would you feel if the stock market tanked 50% tomorrow, or a crypto lost 25% after a Saturday Night Live skit? It helps to have an awareness about what's going on in the market and how you're reacting to it. And maybe instead of reacting, you can mentally prepare yourself so you're proactive and have a ready response depending on the market situation. And it helps to examine your own motivations and identify what your goals might be, whether short-term or long-term goals, as to what you might expect if you participate in certain market activities and what you think are the likely outcomes of the actions you might take. Another thing you can do to get to know yourself and your money behaviors is to create an inventory of what your money is currently invested in or where it's sitting. Like if you have money invested in an IRA or 401k retirement accounts, or an individual investment account that's fully taxable, or if it's sitting in cash, savings, or money market accounts, or if you have it locked up in assets like real estate. And by tracking and monitoring where your money is in, this can help reveal insights to you about your investing behaviors and habits. And you can keep track of this stuff in something like a journal or a spreadsheet, and it can help you evaluate your investing decision-making skills and where there's room for improvement. Mistake number 2 is treating investing like trading. A lot of times when people first fund their investment account, they're very eager to just buy some security or a bunch of securities, and if they don't like them, they then sell them. And we're fortunate that we have a lot of brokers these days who have zero commission fees, so we're able to do this and maybe not see a lot of impact on our portfolio from all of this market activity. But this kind of activity of buying and selling a lot of securities is kind of like going to a shoe store, buying a bunch of shoes without trying them on, taking them home, and then going back to the store the next day and then exchanging them, and constantly buying and selling new shoes a lot until you're finally satisfied. And you don't have to take this level of activity in the stock market or other kinds of marketplaces. You can take your time and let cash sit in your brokerage account as you study and evaluate which securities you would like to be invested in for the long term. And to use a baseball analogy, this is like waiting for the market to offer you your pitch. So the market may offer up a lot of pitches, but that doesn't mean you have to swing at every one of them. So investing is all about finding the right opportunities to invest. Let's say you buy a stock, it goes down a lot, and then you decide to sell it for a loss. and then you're aggressively taking another action because you're trying to compensate for your recent loss. And this could be losing sight of the bigger picture of why you're investing and losing sight of what your goals are, and if you're trying to make this trade for the right reasons or if you're just overcompensating. And not to mention, some studies have shown that frequent trading can lead to worse returns. So it's important that if you're trying to make a new move, that you're doing it for the right reasons and not just because you're feeling sad that you lost out some money and you're trying to make it back as soon as possible. Also, if you're prone to a lot of short-term buying and selling, this can have tax implications down the road. So if you buy a security and then sell it in under a year and you had some gains, this can be subject to what's called short-term capital gains. So I encourage you to look up how much more you would have to pay in taxes as opposed to if you held a security for more than a year and then sold it. And then also, depending how in and out of positions you're in, some brokerages can flag your account for frequent trading. So pay attention to some of the rules if you're doing this, as well as just remember that it's important to still contribute to tax advantage investment accounts like IRAs or 401ks, because you only get the tax year to contribute, but it doesn't mean that you have to invest right away. You can take your time to study and evaluate and then make the right decision. It's like what Warren Buffett says, ignore the market or people saying, swing you bum, and wait for the right pitch or the sweet spot at which you'd like to swing and then make your move. Number 3, obsessively checking whether the prices of your stocks, funds, or other assets went up or down. And I have an interesting analogy. Imagine you're getting married and you do all this work leading up to the point of commitment. You and your spouse exchange rings, and then you're constantly checking whether your spouse is wearing the ring. This is what it's kind of like with investing in stocks or other securities. If you're comfortable with it long term, do you really need to know the price of it every hour or every day of the week? Probably not. And there's this invisible law that as soon as you buy something, the price of it automatically goes down. And this happens to all of us, so I wouldn't sweat it. I like to check my positions once a week, and I kind of like to set it and forget it and not really think about it too much because I have the conviction of my investing thesis and I know I invested enough, and this allows me to sleep at night. Number 4, not fully doing the homework or research and understanding the risks in something that you're considering deploying capital into. And a lot of people tend to think of risk as if it's volatility or the price of a stock or security going up or down. But what risk means to Warren Buffett is the ability to permanently lose capital. So that's a different take on risk and something to consider as to how much risk are you really willing to take on, and to kind of challenge what might be the common ways of defining risk and if it makes sense in the context in which you might be investing. And Charlie Munger likes to invert an investing case. He doesn't just look at all the upside and the case for buying something. He looks at the case of not buying something or against why someone should buy into an asset. And by evaluating both the for and against, you can come up with if you think that the amount of potential reward is worth the risk of investing. And I try to do this because I've definitely bought assets where I didn't fully do my homework and then I live to regret it. So I try to mitigate this risk by studying as much as I can and then knowing all the pros and cons, then committing money to it. Number 5, biting off more than you can chew with extreme bets and or using leverage when you're not ready. And leverage is just borrowed capital that you'll owe someone later. And sometimes people use leverage to increase returns when they don't have as much starting capital to deploy. And maybe you've had a hot streak with things like cryptos or penny stocks, and then you take out a home equity loan and put all the chips in an even bigger bet. And something you got to ask yourself is if you've successfully used leverage before in smaller amounts, and if you're doing well with them, that you can gradually build up, because while you can gain outsized returns, you can also magnify your losses if you don't know what you're doing. And Warren Buffett has said, you really don't need leverage much in this world. If you're smart, you'll make a lot of money without borrowing. And this just goes to show, beware if you want to try to accelerate your returns by borrowing money, because it can be really tempting to generate higher returns. But if you're not ready or able to handle that type of responsibility, I wouldn't go there, especially as a beginner. Number 6, comparing yourself to others. You might be a certain age and you see other people who are already successful at your age, and then you think you're behind, and then you're trying hard to force things and maybe over allocating to try to get increased returns, and then you risk maybe not having enough money left over for an emergency fund if your money is tied up in certain investments and you're afraid to take it out. You don't want to end up in this situation. It might be a little bit too stressful, and you're not letting yourself live your own life by trying to catch up to the Joneses. And we all know there's no get-rich-quick schemes. I know there's a lot of people who are playing the lottery or the crypto markets hoping to hit it big someday, but I don't really trust trying to get wealthy that way. I'd rather put in the hard work and maintain control so that I don't just leave it up to chance. Number 7, not challenging the asset allocation status quo. And often it's too easy to trust arbitrary asset allocation strategies about being really diversified, or other common advice like you should increase the amount of bonds you're in as you get older. And I want to know, what is the evidence of being invested in more bonds as you get older? Why is that safer than being invested in stocks or other things? It's like people say to spin a wheel of arbitrary assets you should be allocated to, and then you find yourself having some percentage in emerging equities or large cap, mid cap, small cap, and a full range of random funds that you're not really sure what you're truly invested in. So I encourage you to question common shortcuts that people say to do, like if you're too risk averse, then invest in this. I mean, it's a little bit too easy and too simple to just chalk up an asset allocation to a pie chart and make it an academic exercise of putting what will be an important nest egg in your retirement future into a simplified, common asset allocation model, because life isn't that simple, and you should definitely consider what makes the most sense for you, your portfolio, and your goals. Also, some people might make you believe that you have to choose all or nothing, like whether you want your money to be actively or passively managed in the context of putting it into a bunch of funds. So if you choose to put your money in an actively managed mutual fund, that's where there's a money manager on the other side picking the stocks for that fund. Or if you put your money into a passive index fund that tracks a popular market index like the S&P 500, then you get the returns of whatever that overall S&P 500 fund will get you. And it doesn't have to be this way. You can decide on whatever mixture of assets that your resources of time, money, and interest or aptitude will allow. For example, I would encourage you to make a list of the types of assets that you can either afford to buy today or that you might like to buy in the future, and determine the pros and cons of each of those, and then decide what makes sense for you to be invested in and how much time you want to be spending researching these things, or if you want to trust an active money manager to do the investing on your behalf. But you can just allocate a certain percentage to that. It doesn't have to be all of your net worth in an all or nothing type of way. Number 8, letting perfection be the enemy of practicing investing. And some people have a preconceived ideal of what it means to invest, and they're feeling intimidated from not feeling like they know enough, or not having enough money with which to invest, or being intimidated by all the jargon like tax loss harvesting, strangles and straddles, and all of that is nonsense. People shouldn't feel like they have to know everything before they can get started learning something. And what it means to practice investing doesn't mean that you're invested from day one, but that you're willing to have an open mind about the different points of view and approaches to investing, so that you formulate your own approach to what you feel like is a right way to invest for you. And it would be ideal, and I certainly wish I could be 100% fully invested all the time. But no one is twisting your arm saying that you have to be invested from day one or fully invested all the time. And it's hard to do this because it's difficult to time when we either buy into a position or sell a position. So it's difficult to maintain full investment in all the assets that we want and at the prices that we think make sense. And the important thing is to just contribute to your retirement tax advantage accounts, because you only have a certain window of time with which to contribute, but that doesn't mean you have to act on what you've contributed, and doesn't mean that you have to fully invest all those contributions right away. It's definitely important to still study and figure out what's the best asset that you want to put that money into. And like Charlie Munger says, he just tries to do the best he can and not be stupid. And in a similar way, I try to not be dumb with how I allocate my investing dollars. Those were the top 8 investing mistakes I wanted to cover today. And if you want to learn more, I encourage you to check out my video, How to Invest Getting Started for Beginners. And I also encourage you to read other books and learn from other sources so that you can formulate your own investing practice approach. And there's no one investing cookbook that suits all. There are many recipes to investing success. But if I had to recommend one book that I think is especially good, it would be Invested by Danielle Town and Phil Town. I love that book so much that I recommend it to everybody, including my friends and family. And it's important to think of investing as a practice that you do on a long journey, not as a game that has to be won in a short window of time. And if you think about it this way, you'll take different actions than letting yourself get sucked into the latest meme game of musical chairs. And if you enjoyed this video or learned something, please like and subscribe. And I wish you well on your journey towards becoming the best investor you can be. Till next time.